Now speaking, Carrie Bernstein, Head of Investor Relations. Thank you for joining today's call. We are pleased to report strong results for the quarter, with total revenues of $10.9 billion, up 8% from the prior year. Net income was $2.1 billion, up 11%, and earnings per share were $2.07, up 12%. Our results reflect continued growth in card member spending, higher net interest income, and a lower effective tax rate. We also saw strong growth in our global merchant services business, driven by higher merchant volumes and increased merchant acceptance. Jeff will provide more detail on our financial performance shortly. We are also making progress on our strategic initiatives, including expanding our digital capabilities, investing in new products and services, and driving efficiency across the company. We remain focused on delivering value to our customers, shareholders, and employees. Now speaking, Steve Squeri, Chairman and Chief Executive Officer. Good morning, everyone. Thank you for joining us today for our second quarter earnings call. This quarter marks the sixth consecutive quarter of strong performance since we announced our growth plan in January of 2022. Revenues of $15 billion grew 12% year-over-year and reached a record high for the fifth straight quarter. Earnings per share of $2.89 is also a quarterly record and is up 12% over the last year. We are reaffirming our guidance for the year of delivering revenue growth of 15% to 17% and EPS of $11 to $11.40. Our long-term aspirations are to achieve annual revenue growth in excess of 10% and mid-teens EPS growth in 2024 and beyond. Our differentiated business model is built largely around a fee-based premium products, which drive our spend-centric economics and produced a fast-growing stream of subscription-like revenues. We have a long history of partnering with brands who share our values, and we recently signed a 10-year extension of our relationship with Hilton, which includes continuing as the exclusive co-brand issuer of Hilton consumer and small business cards in the United States, as well as extensions of our travel and merchant relationships. Our second quarter performance was driven by our differentiated model. Card member spending hit another all-time high in the quarter, with U.S. consumers and card members outside the U.S., both up by double digits. Millennial and Gen Z consumers continue to be the fastest-growing portion of our card member base, with U.S. billings up 21% in the quarter. Our international card business was again the fastest-growing segment. We saw strong growth in travel and entertainment spending, restaurant reservations through our Resi platform, and bookings to our consumer travel business. Over 70% of the new accounts we acquired were on fee-based products, and more than 60% of new customer accounts acquired globally are coming from millennials and Gen Zs. Our credit metrics remain best in class, supported by the premium nature of our customer base, our robust risk management capabilities, and the thoughtful underwriting actions we take on an ongoing basis. We are pleased to announce that we've signed a 10-year extension of our relationship with Hilton, which includes continuing as the exclusive co-brand issuer of Hilton consumer and small business cards in the United States, as well as extensions of our travel and merchant relationships. This extension builds on the strong foundation we built over the years with Hilton and gives us a long runway to invest in products and services and experiences that attract new customers and deepen our relationships with existing ones. We are confident in our ability to achieve our long-term aspirations of annual revenue growth in excess of 10% and mid-teens EPS growth in 2024 and beyond. Now speaking, Jeff Campbell, Chief Financial Officer. Good morning, everyone. Our second quarter results are tracking with the guidance we gave for the full year and reflect steady progress against our long-term growth aspirations. We saw record levels of spending on our network for the fifth straight quarter, with total network volumes and billed business up 9% and 8% year-over-year, respectively, on an FX-adjusted basis. This drove reported net income of $2.2 billion and earnings per share of $2.89, up 12% year-over-year. Goods and services spending grew 6% overall in the second quarter, with strong growth in U.S. consumer and international card services of 8% and 15%, respectively. Travel and entertainment spending across geographies and customer types was up 14%. U.S. consumer billings grew 10% this quarter, driven by millennial and Gen Z customers whose spending grew 21%. International consumers and SME and large corporate customers grew 16% and 19%, respectively. U.S. SME spending growth slowed down a bit further from last quarter. U.S. large and global corporate customers grew billings 2%. Card member loans and receivables write-off and delinquency rates remain below pre-pandemic levels. We ended the second quarter with $4.7 billion of reserves, representing 2.6% of our total loans and card member receivables. Total revenues were up 13% year-over-year in the second quarter on an FX-adjusted basis. Discount revenue grew 8%, net card fee revenues were up 22%, and net interest income was up 32%. Variable customer engagement expenses came in at 42% total revenues in the second quarter. We invested $1.4 billion in marketing in the quarter. Operating expenses were $3.4 billion in the second quarter. We returned $1.6 billion of capital to our shareholders in the second quarter, including common stock purchases of $1.1 billion and $446 million in common stock dividends. We are reconfirming today our 2023 full-year revenue guidance of 15% to 17% growth, with EPS in the range of $11 to $11.40. Our revenue momentum and customer acquisition trends are positioning us well for our growth aspirations this year in 2024 and beyond. Keefe, Bruyette & Woods analyst Sanjay Sakrani inquired, Jeff, what gives you the confidence that build business growth will stabilize and what do you need in the back half to reach your revenue guidance? Jeff Campbell replied, I don't see us above trend, Sanjay. We have seen stabilization in our business across geographies, which is consistent with a low-growth economy. Our volume growth this quarter has been strong and allows us to meet our guidance for this year and our longer-term growth aspirations. Even in this low-growth economy, we are confident that we can achieve our goals. Steve Squeri replied, consumer spending in the U.S. is up 10%, and travel bookings are higher than pre-pandemic, last year, and 2019. International travel is coming back strong for us. We had a little hangover from Omicron this quarter due to spending push from the first quarter to the second quarter last year. We feel good about our record billings and we're still acquiring card members with good credit. We expect spending to pick up as the economy improves. Goldman Sachs analyst Ryan Nash inquired, Steve, what are the key drivers of T&E remaining in double digits year over year? What is driving the slowdown in commercial growth and what do we need to see for reacceleration? Steve Squeri replied, from a T&E perspective, Delta is seeing record growth and we have a line of sight into future bookings. Our biggest segment in T&E is restaurant, which grew 15%. We're seeing people back traveling and strong T&E growth. In large corporate, it's crawling its way back and is about 5% of our business. Small business organic growth has slowed, but we're focused on acquiring more customers and meeting their other needs. We would prefer that our SME business was growing like our consumer business, but there is an industry-wide slowdown from a small business perspective. We'll be poised for the recovery when it comes. Morgan Stanley analyst Betsy Grisek inquired, Jeff, could you explain how the other lines of revenue, such as net interest income and fees, will make up for the slower billings growth anticipated in the second half of the year to meet the 15 to 17% rev guide? Jeff Campbell replied, Betsy, this quarter we saw some unusual noise in the service fees and other revenue line due to a complicated litigation settlement in the prior year. However, we are still seeing consistent high growth in net card fees, up 21% this quarter, combined with customers rebuilding balances on the net interest income side. When you take out the noise from the service fee and other revenue line, we are on track to meet our full-year guidance. Steve Squeri replied, card fee growth has been strong for the past 3 quarters, with 20% growth each quarter. We are also benefiting from net interest income and billings are at a level that allows us to meet our revenue guidance. This is due to the three-legged stool of revenue we have in place. J.P. Morgan Chase & Company analyst Rick Shane inquired, Jeff, what factors do you believe will lead to an acceleration of top-line revenue in the second half of the year? Steve Squeri replied, we remain confident that we will be within the 15 to 17% range. We had a record quarter of billings at over $420 billion, which is why we give ranges. We anticipate the results to land within that range. William Blair & Company analyst Bob Napoli inquired, Christoph, what should we expect in terms of credit normalization as you look at your portfolio for 2024 and beyond? Jeff Campbell replied, Bob, thank you for your kind words. Our SME portfolio has seen strong growth this quarter, both in terms of total number and same business activity. We have seen a slight uptick in delinquencies in recent vintages, but overall our credit metrics remain strong and we are confident that we will be below 2019 levels in all areas. We have made prudent product, acquisition and risk management choices which have enabled us to remain resilient in this environment. I want to be clear that we have taken a prudent approach to risk management over the past year. We have made adjustments to ensure that our portfolio is well positioned for the future. We remain confident in our ability to manage risk and continue to deliver strong returns. Steve Squeri replied, organic growth for SME is likely to remain flat, while acquisition and attrition are expected to remain stable. The biggest difference is organic growth, which was bolstered by small businesses using cards to run their entire business during the pandemic. This led to increased buying of goods and services, as well as inventory, which we will be monitoring closely. MoffettNathanson analyst Lisa Ellis inquired, what changes have you seen in the underlying business drivers since you introduced your long-term plan to double-digit revenue growth and mid-teens EPS growth 6 quarters ago? How has your strategy evolved as we return to a more normalized economy? Steve Squeri replied, I think our strategic priorities have enabled us to exceed our original expectations. We anticipated a slower growth environment, yet we achieved 25% revenue growth last year. Our 15 to 17% guidance for this year is based on our original 17 to 19% guidance. We've made great coverage gains, especially internationally, and our key partnerships with Delta, Marriott, and BA are cemented for the long term. Our model is differentiated from our competitors as we play across three different dimensions of card fees, billings, and net interest income. This has enabled us to stay focused on our priorities and achieve success. Citi analyst Aaron Siganovich inquired, what is your outlook for marketing expenses in the second half of the year, and what have been the growth rates of Build business quarter to date? Steve Squeri replied, we plan to spend $5.5 billion on marketing this year. We're around $100 million from last year in this quarter, but it can vary depending on the programs and timing. Our marketing spend is mainly for customer acquisition, affiliate fees, incentives, etc., not TV or print advertising. Oppenheimer & Company analyst Dominic Gabriel inquired, has the contribution of net card fees to total revenue changed over time in relation to your 10% revenue goal? Steve Squeri replied, no, the card fee is a big differentiator for us. It's a subscription-based revenue stream that we're pleased with. We anticipated this level of growth and it's been consistent for 3 quarters in a row, growing at 20%. Even during the pandemic, it was growing in double digits. This is a major contributor and it's in line with our expectations. Jeff Campbell replied, Dominic, our product has seen tremendous growth over the past year, with double-digit increases even during the pandemic. This is a key strength of our company, as it helps to engage customers and build loyalty to our product. We anticipate this trend to continue and for our product to become an even bigger part of our revenue. Steve Squeri replied, our long-term investment in our customers during the pandemic paid off with double-digit growth. We chose to invest in our existing customers rather than drop more money to the bottom line. This allowed us to improve our value propositions and retention rates, which kept our card fees going. Our members see value in the product and it's our job to continue to insert more value into the product, which is why refreshing our products is a key part of our strategy. Wells Fargo Securities analyst Don Fandetti inquired, Jeff, can you clarify if the Basel comments mean that the CET1 ratio won't have to be higher than the target of 10 to 11? Jeff Campbell replied, Don, you were asking about the CET1 target in Basel III. Our 10% to 11% CET1 target is more driven by our own view and rating agency views than the regulatory minimum of 7%. We have a return on equity of over 30%, so we can quickly replenish capital without taking a pause from share repurchase. There's been a lot of attention paid to different iterations of Basel III, particularly around ops risk, but it's only one component. We don't see it as a material event for this company because it's possible there's no change in our target, and even a modest change with our 30% plus row won't have a material impact on share repurchase or our EPS growth. Bank of America Merrill Lynch analyst Mir Badia inquired, what is driving the momentum in process revenues and network partnerships in the oil and G&S business? Steve Squeri replied, no, nothing has changed in terms of our focus on getting partners to join our network. Our G&S team is actively searching for new partners and we operate in 29 proprietary countries. We have seen improvements in coverage due to our G&S partners. Our launch of the Square card has been in the pipeline for a while, but it's different to hook up to our systems and get priority within your own system. The team is consistently working across Asia, South America, Africa, and other regions to get more coverage and cards issued. They have been hard at work for many years and the Square partnership has received more attention due to its U.S. status. Carrie Bernstein replied, we appreciate everyone joining us today for American Express quarterly earnings call. We thank you for your continued interest in our company. Our IR team is available for any follow-up questions. That concludes our call for today. Thank you for participating. You may now disconnect.